In terms of looking at gold stocks at Casey Research, what are the kind of things that you like to see? I notice in your Golden Resource Report, you have a lot of valuations. You have large producers, mid-tiered, small producers, royalties. Talk about what you like to see and how you evaluate gold stocks. What makes your report unique and what you guys do unique?
Well, the Casey Golden Resource Report is basically an entry-level letter for someone who is not terribly familiar with gold, is just getting started investing in gold. It's a great letter for someone like that. It goes over basic information. We provide great resources. And yes, we have a proprietary evaluation formula that looks at each company individually and assesses it for value in terms of its mine asset value, how much gold it has in the ground, what that gold is worth, what it costs to get it out, and then, of course, what they can sell it for, versus their market cap and how much has already been put into the stock. So it's a formula that's displayed right on our website for subscribers, and it's a great formula for determining if a stock is overvalued or undervalued or fairly valued. And many of the stocks in our portfolio right now, believe it or not, are still undervalued. And the reason they're undervalued is because the gold price is making the assets in the ground much more valuable. We do have a couple stocks that appear to be a little frothy, and that would include Agnico Eagle as being one of them. As much as we like the company, the stock itself is fairly valued at this point. A good example of one being probably overvalued is Randgold. It's a company we like, exploring in Africa and producing in Africa. But the stock itself has really had quite a run. It's our 2009 winner so far this year. But it's had such a run that I'd probably be cautious about buying it now. Doesn't mean that it couldn't continue to go up, but it has gotten a little frothy.
You know, one stock that a lot of people in the gold camp have, it's kind of love and hate relationship, which has been Barrick Gold. From a valuation point of view, its valuation ratios are very, very low. But, you know, more significantly, recently they did a financing and they're paying down their hedge book. So it sounds to me like they finally discovered religion in the gold market.
Very well put. When the CEO went around and asked analysts what he could do to make the company more attractive, he was told repeatedly, get rid of the hedge book. And that's essentially what they're trying to do. The recent financing you're talking about will get rid of about two-thirds of their hedge book. And that is definitely going to make them more attractive. So the financing did dilute shareholders somewhat, but I think in the long run it's going to make them more attractive and more leverage to gold, and that's the real key to a gold stock. You want to make sure they're getting leverage. If you look at Barrick's price history, it's not been terribly great. We have a hold on the stock, and that's the primary reason the hedge book has been such a drag. And even though they're releasing much of the hedge book at this point and paying, a lot of it off, they're going to struggle for a couple quarters probably with profit margins because of that raise. There was an awful lot of money that went into the stock in order to do that.
If you were looking forward, if you and I were having this conversation, let's say next spring, there's been a lot of targets that have been given for the price of gold, both by people on the fundamental side and people on the technical side. And it seems they're in fairly close proximity of each other, both camps, and it's somewhere in that $1,200 to $1,300 range. As you look forward, can you see that possibility?
Oh, easily, yes. The fine print, or the asterisk beside my answer, though, is that we're not really out of a deflationary environment yet. Deleveraging may not be over, and we haven't really seen high inflation yet. We haven't seen hardly any inflation. We've seen monetary inflation, but we certainly aren't seeing price inflation. And when that kicks in is when you're really going to see the gold price take off. That could be in 2010, that could be in 2011, that could be in 2012. I don't think it's going to go, not quite that far, but anything can happen in the short term. A lot of newsletter writers used to talk about a $2,000 gold price, but after what the government's done to the dollar, both in terms of debt and money printing, the $2,000 isn't going to be high enough. $2,000 may sound high now, and I think we'd all be pretty excited if it hit that price next year. But a high inflationary environment, it may feel low. It may take a $4,000 or $5,000 gold price to equal what $2,000 feels like today. If that happens to gold, we believe the gold stocks are going to just absolutely scream. They're going to have to. If I told you my favorite gold-producing companies were going to double or triple, that may sound exciting, but that could be woefully low if we have 10% inflation or higher, which is certainly feasible. Of course, everything else will be going up then, too. But the point is, once inflation hits, look out. So the best advice is to buy on pullbacks, buy when things drop, and just hold. That's been my mantra, just buy, hold, repeat. Buy when prices are low and on pullbacks, and just hold on till we get a mania someday.
Given the outlook for the dollar and given the super size of America's deficits and unfunded liabilities, are you aware, Jeff, of any situation where a country as large as ours, which is a debtor nation, on a fiat currency system where the ultimate outlook wasn't inflationary?
No, I don't know how they're going to get out of this. Well, it's obvious they're not going to get out of it. There's two reasons. One is because of all the money printing that they've done. We've all talked about the monetary base. It's now $1.7 trillion, which is more than double what it was just 12 months ago. I mean, for every dollar in America a year ago, the U.S. government created 2.1 of them. That's beyond unprecedented. And then you have all the debt. How is this debt going to be paid off? You have government spending year to date is almost $3 trillion. The government bailouts are $12 trillion. Unfunded liabilities are $58 trillion. There's only three ways out. They can raise taxes, and they probably will. They can cut spending. They'll try to do that. Or they can just allow inflation to rise from all the money printing, diluting the burden of debt. And that's probably what they're going to do. In fact, I saw a quote not too long ago. He was a former White House advisor, and he and the IMF chief economist actually stated in writing what the U.S. economy may need is a dose of good old-fashioned inflation. So what does that tell you? That tells you that inflation is going to be allowed. They're going to let it happen. They're bringing it on. They're going to let the dollar devalue, and that's going to do one and only one thing to the gold price. It's going to have to go up. So I don't believe that there's really any, I'm not an economist, but I don't believe that there's any way for the government to get out of this. There's going to be inflation. The dollar's going to have to go down, and the gold and silver price are both going to benefit from that.
I agree with you 100%. Well, listen, Jeff, if our listeners would like to find out more about the report that you edit, Casey's Golden Resource Report, tell them how they could do so, please.
Well, it's very easy. You just go to caseyresearch.com on the website there, and we have, I think it's 8 or 9 different newsletters now, and you can click to check out the Golden Resource Report there. There's a description there and of all the newsletters, and, of course, you can subscribe there and check it out. It's only $39 a year, so it's a very inexpensive way for someone to check out Casey Research and get what we think is some of the best research in the industry on gold.
All right. Well, listen, Jeff, I want to thank you for joining us this week in Other Voices. I wish you all the best, and I hope you'll come back and talk to us again.
I will. Thank you.